Hello, everybody. Welcome to the KyebyeWay, where we make investing so simple that you'll be ready to invest with confidence. I am Aditya, and I'm here to teach you one simple rule: know your exit before you enter. And that's exactly what KyebyeWay stands for. So, we'll be bringing you the same video in English, Tamil, and Kannada. So, let's grab a seat, relax, and decode investing and life one step at a time. Yep, come on, let's go ahead. So friends, before we proceed, I kindly request you to watch the first module if you have not yet. I'll give the description, I'll give the link to the first module in the description below. So before you proceed with the second module, because there are a lot of interconnections between both the modules. Okay, so please watch the first module and then we can move on to the second one. All right, so having said that, let's proceed with what we are going to do with the second module. So let's quickly look at the recap of first module. We learned about the story of Mr. Radhakishan Damani and his investing takeaways. We understood about his principles, like he always believes in sticking with the quality companies. That's where he needs to, one should invest his or her money. Do not gamble with money. If you don't know, don't invest. Try not to miss an opportunity, diversify, and think long term. These were some of his principles that we learned from the first modules. Yeah. And then we saw what are all the financial terms from the first module. We saw what's an asset, liability, we saw what is an equity, we saw inflation. One of the most important throughout all the modules is going to be inflation. Please remember that. So that is why I told you, if you've not seen the first module yet, kindly watch the first module and then proceed with the second one. Okay. And then what did we see? We saw what is an IPO. Okay, initial public offering. Come on, let's see what happened next. Next, we saw different investment avenues available, like your FDs, gold, real estate, bonds, and equities or the stock market. Right? So all these have been covered in the first module. And then we saw what is an FD, fixed deposit, and we saw where all this account can be opened in banks, post office, NBFC, right? And we also saw what are the benefits of fixed deposit, the rate of return or the interest that we get for the principal amount that we deposit, and the disadvantages of fixed deposits. We also saw the different kinds of banks, how many banks are there under PSU banks, that is public sector undertaking. We saw how many private banks are there and the number of banks that are listed in India under private sector. We also saw what does NBFC stands for and the number of NBFCs and their names, right? The top ones, the most famous ones, right? So if you have any questions regarding the first module, I kindly request you to post them in the comments section below or in the first module. I'll try my best to answer them as quickly as possible. Okay, so with that, let's proceed with our second module, which is going to be the core subject for today. So module 2 begins with iconic investors. Remember, in each module, we're going to be covering one iconic investor and their life story, their principles, because that is definitely going to aid us in our investment journey. Okay, so let's see who's this particular iconic investor that we've got in store for today. Arguably, he's one of the greatest investor of all time. Yeah, he was born in 1960, and like Mr. Damani from the first module, even this gentleman hails from a middle class family. His father was an income tax officer who was also interested in the stock market. So, since his childhood, he would often hear stock market discussions at home, sparking his curiosity, which is why we say it's extremely important to keep a tab of what we see, what we hear, and what we speak at home, especially if there are kids around. Okay, because knowingly or unknowingly, all these discussions will be submerged in their conscience. Okay, so from there, his father, however, discouraged him from investing until he had completed his formal education. So, our gentleman, what he did was he completed CA, Chartered Accountancy, and he began investing in the stock market in the year 1985 with just rupees 5,000. Okay, so after completing his degree, he got an initial sum of 5,000 rupees and entered the stock market in the year 1985. Let's see what happens next. At the age of 25, his first big success came in 1986 when he bought shares of a company called Tata Tea. I'm sure you guys are all aware of Tata, right? One of the biggest group in India. So Tata Tea, and he saw an opportunity when the stock price dropped, even though the fundamentals of the company remained strong. So despite the fundamentals being strong, the stock price started falling, and immediately what does our man do? He quickly goes back to the drawing board and checks the fundamentals of the company, and he comes to the conclusion that there's absolutely nothing wrong with the fundamentals, and this is quite common in stock market. Despite the fundamentals being good, price tends to be volatile, or it tends to go up and down randomly, right? So what did he do? He purchased 5,000 shares at rupees 43 each, and within 3 months the price soared to 143 rupees per share. So this is the power of stock market. So if you are believe in the fundamentals, if you're someone who's has a strong inclination towards fundamentals, that is a basic structure how the company is formed, then you don't have to worry about the price fluctuations. Okay, and this early win gave him the confidence, and he made a profit of over 5 lakh rupees. And back then in 1986, that was a huge amount, right? So from here, let's see what happens next. So one of his most famous and profitable investments was in Titan, the watch company or the jewelry or the eyewear company that we all know, right? It's a subsidiary of the Tata Group. Okay, so Tanishq, which is also one of the jewelry wing of Titan, and the Titan Eye, and of course the watch company, the Titan. Okay, this is again a subgroup of Tata. Okay, so he bought a significant stake in the company in the early 2000s when it was trading at a very low price. Over the years, Titan became one of the largest watch and jewelry retailers in India, and his investment in Titan turned into a multi-bagger, making him billions of rupees. Do you know how much he bought those shares for? Let's see that. According to Equity Master, which is a research journal, the Indian billionaire with Midas touch had bought 8 crore shares of Titan during 2002 and 2003 at an average price of rupees 3 per share. So he invested close to around 24 crores. So just imagine, in 1986 he makes his net worth from 5,000 goes up to 5 lakh rupees, and from then to 2002 and 3 he's amassed a wealth of close to 25 crores, right? Making small investments in quality companies. So just imagine, if you give time for your investments, definitely the sky is the limit. Okay, so the share price of Titan since then, since 2000, when he invested, it was around about this time, this period, around 3 rupees, and as we speak it has gone all the way up to 3,737, and where are we now? Almost the end of 2024. So it's close to about a little over yeah, about 20 years, and this is what has happened to his wealth. He bought it close to around, look at this price, close to around 3.5, 4 rupees. So average price was around 3 rupees. And what is the price today? It is 3,737 rupees. So imagine the amount of wealth he could have amassed. In between, you also have he would have got both bonus shares, stock splits, all those. Sorry, I'm really sorry to bring those concepts so early. As we proceed further, we will discuss about all those jargons. So don't worry, this is what is the power of long-term investing. Yeah. So that is why pick good companies, keep adding those shares, and hold on for longer duration. Okay, excellent. Let's see what happens next. He is none other than our own big bull. I'm sure you all would have guessed him by now, right? Yes, he is Mr. Rakesh Jhunjhunwala. Like we all know, the big bull of India. She is Miss Rekha Jhunjhunwala, Mrs. Rekha Jhunjhunwala, who's Mr. Rakesh Jhunjhunwala's wife. Yeah, so unfortunately, he passed away in the year 2022, but he's left with a lot of principles and one of the greatest investment minds that our country has ever seen. Okay, so just imagine what 5,000 rupees can do to you, right? If you have the right knowledge and if you invest in the right avenues, this is how wealth is created. And from here on, let's see what happens next. His estimated net worth in 2022, when he just before he passed away, at the time was 40,000 crores. Can you just imagine what 5,000 rupees, if invested and held on for a longer duration, and of course, it doesn't mean you just buy one stock and hold it for long term. As and when possible, you have to keep booking your profits, reshuffling it. So a lot of things are there. Don't worry, we'll learn all those techniques as we proceed in these modules. Okay. So this is what I'm trying to tell you, that 5,000 rupees has become 40,000 rupees. So just imagine the power of long-term investing. And few of Mr. Rakesh Jhunjhunwala's investments as on 2022 were Titan, Fortis Healthcare, CRISIL Research Agency. We'll see what it is as we proceed. Federal Bank, Canara Bank, Star Health Insurance, to name a few. So again, my friends, like I told you in the previous module, this is not a stock recommendation. So kindly do not go ahead and buy these stocks. This is just to show you what were all the stocks that were there in his portfolio during 2022. Okay. So, my dear friends, what are the key takeaways? Educate yourself, equip yourself, and get financially literate. This, by far, is the most important aspect of anybody's life, right? So, among all the subjects that we learn throughout our education life or throughout our careers, this is very, very, very important. So, please spread this video as much as possible, especially with the younger generation, kids from high school onwards, college kids, or people who have just started their careers, so that they can start investing as early as possible. The biggest weapon that they have is time. Time is on their side. So the sooner they start, the longer they can hold their investments and the wealthier they can become. Okay, so please spread this video as much as possible. Okay, thank you. Now, Mr. Jhunjhunwala believed in the power of long-term investing, right? Like Mr. Damani, even Mr. Jhunjhunwala believed in the same concept. And his success was a testament to his belief as he held on to his investments through market fluctuations, reaping significant rewards over time. And not just that, he always used to say, never invest at unreasonable valuations and never run for companies which are in limelight. So these were his principles when it comes to investment. Okay, so hope you all have gained some knowledge from Mr. Jhunjhunwala's investment journey. All right. So with that, the stock market is a device for transferring money from the impatient to the patient, says Mr. Rakesh Jhunjhunwala. How profound is that, right? So if you're impatient, if you're going to be taking speculative trades, then God save you. If you might strike gold once, twice, but eventually you will fail and lose everything that you have. So be patient and always believe in long-term investing. All right? Excellent. So if a man with 5,000 rupees can make it to 40,000 crores even you can do it as well. So just ensure the best investment you can make is in yourself, says another legend from the investing world, Mr. Warren Buffett, right? One of the top 10 richest man on planet Earth, right? And age doesn't matter because he, as we speak, Mr. Warren Buffett is above 90, and if he can, so can you. So please uh, educate yourself when it comes to finance, and like and share this video with as many younger generation as possible, because as I told you before, time is the wealth, and they have time on their hands. That's the biggest weapon. So as we proceed, we're going to be covering a lot of points, lot of different asset classes, how to invest, what to do, what not to do, as we proceed in future modules. So this is going to be extremely helpful for the upcoming generations. All right. Thank you. So please don't forget the ultimate investment mantra, the KyebyeWay. Know your exit before you enter. So like always, before we proceed with the module, with the core subject, they're going to be learning a few financial terms. And today, what we have in store is commodity. A commodity is a basic good or raw material that people buy and sell, typically in large quantities, and it's usually the same no matter who produces it. Okay, so irrespective of where it comes from, who produces it, it holds a true value of its own. So think of it like gold, oil, wheat, uh, your copper, all these are called as commodities. They're pretty much the same whether they come from one place or the other. Okay, they hold value of their own, right? Excellent. So the next financial term that we're going to learn today is, oh yeah, I'm so sorry, I forgot about the examples, right? So gold, which is used in jewelry and electronics. So if you buy gold in India or the US, it's the same type of material, right? So irrespective of where it is made or who sells it, gold is gold. Same goes with crude oil as well. Whether it's produced in the Arab countries or Russia, America, or whichever country on planet Earth, it doesn't matter. Oil holds its intrinsic value. It has a value of its own, right? And same goes with wheat. And people trade in commodities because they are essential goods with predictable demand, making them important in global markets. All right, so this is what is commodities. So let's move on with the next financial term. So the next financial term is by far the most important term of all when it comes to investing, right? So it is called intrinsic value. So kindly give as much importance as possible to this one particular term, like we did in the first module, which was we learned one very important financial term in the previous module also, which is inflation. Similarly, intrinsic value is one of the most important term in investing, right? So investing, I'm sorry, interesting, sorry, pardon me, interest intrinsic value is the true value or underlying value of an asset based on its actual qualities and potential to generate income rather than its current market price, right? So it's what the asset is really worth regardless of how much people are willing to pay for it right now. Is it a bit confusing? Right, let's see this example. I'm sure you'll be able to understand it a lot better. Okay. So let's say you want to buy a tomato, right? So you would go to the store. If it is 10 rupees, you'll gladly buy a kilogram of tomato, right? A kg of tomato, and the same tomato becomes uh, 50 rupees in a week's time due to increase in prices. So demand and supply, inflation, all those things we studied, right? So those things. So in case if it goes to 50 rupees, you may not buy a kilo of tomato. You may buy just half a kg. From there, let's say another week goes by and the price shoots up to 100 per kg. It has happened in the past, right? So then what do we do? We may not even buy a tomato. Instead, we choose some other vegetable, and our end product is also going to be different, right? So it's always very, very important, even in investing, you always look for a 10 rupee tomato before investing. So let's say if you want to buy a stock and it is trading at 100 rupees, okay, and in the share market, but you do the research and you find out based on its profits, its growth potentials, assets and future outlook, you understand the true value is 150, or the intrinsic value is 150 rupees per share. So this means the stock is undervalued. So this gives you a potential investment opportunity. All right. So, and you might even consider it to buy a good buy because you believe its true value or worth is more than what people are paying currently. Right? Like what Mr. Rakesh Jhunjhunwala did when the price of Tata Tea started falling. He did his homework. He found out that no, the true value is actually a lot more, and I'm getting it for a much lower price. And he invested 5,000 shares in 5,000 shares, right? And then similarly, what he did with Titan also, right? So intrinsic value is extremely important in our financial journey. So don't worry how to find out the intrinsic value and all. We are going to learn as we proceed further. All right? Excellent. So I've also brought another example because this concept is very, very important. So please pay attention. Think of a house, the market price may be 50 lakhs, okay? But after evaluating the location, construction quality, future development plans in the area, the rental potential, you estimate its intrinsic value at 60 lakh rupees. So in this case, the house is priced lower than what you believe it's really worth, okay? So in investing, people try to buy assets when their intrinsic value is higher than their market price, believing the price will eventually catch up to its true worth. Right? So this is value that you get, and this is the time, and this line is your intrinsic value. So when the price goes above intrinsic value, the demand slows down, and the price tends to fall down. And when the price is below its intrinsic value, the demand picks up. And then what happens? It again, as the demand goes higher and higher, the price again overshoots its intrinsic value. So this is exactly how demand and supply works on intrinsic value, right? So intrinsic value is by far one of the most important topics in your financial journey. So please, if you don't understand, please rewind it. And if you have any questions, kindly post them in the comments below. I will try my best to answer it as quickly as possible. Okay? Excellent. So come, let's see what's next in store. A return on investment, or also called as ROI. Return on investment is a simple way to measure how much money you've made or lost from an investment compared to how much you originally put in, right? And please remember, it's always expressed in percentage. So you can easily see whether the investment was worth it. Let's see it with an example. So it'll help you understand a lot better. Okay, so let's say you invest 10,000 rupees in stocks, and after a year the price shoots up because the company is performing well, and the price goes all the way up to 12,000 rupees. So your profit is 2,000. How did we arrive? It is your current price, which is 12,000, minus your initial investment, which is 10,000 rupees. That will give you 2,000 rupees, right? Now we need this to be converted into percentage, right? So what do we have to do? The return on investment is 2000, which is your profit, divided by your initial investment, which is 10,000 rupees, into 100, because we want it in terms of percentage. That will give you 20%. So please remember, this is not just done only for profits, even for loss, the calculation method is the same. So let's say you invested 10,000 and after a year the stock price has gone to 8,000 rupees. So you actually looking at 2,000 rupees loss, right? Because 8,000 rupees minus 10,000 is minus 2,000. So how do we calculate the percentage? The same thing. It is minus 2,000 divided by 10,000 into 100, which will give you again minus 20%, right? So this ROI, rate of return, or return on investment, should be or can be used for both profit and loss. So this means in our example, you've gained 20% on your initial or original investment. All right. So brilliant. Let's move on with our next financial term. Rule of 72. This is a very interesting, very intriguing concept that I really like. What it simply says is it's a way to estimate how long it will take for my money to double, right? This is based on a fixed annual rate of return. So you just divide 72 by the interest rate or return rate to get the number of years it will take for your investment to double, right? Let's see an example so it'll make it a lot easier for you. So you invest in a scheme which let's say it gives you 6%. In our first module we saw FDs, that is fixed deposits. One of the examples were it was giving you 6% returns, right? So how long will it take for you to double your money? So all that you have to do is just divide the number 72 with the rate of return, which is 6%. So 72 divided by 6 is 12, right? So in short, it means it'll take about 12 years for your money to double at a rate of return of 6%, right? Isn't it interesting? So let's say tomorrow you go to a bank and you want to open an FD. The bank says, you know what, we'll give you 6% or 7%. Quickly, what you can do is divide 72 by 7%, and whatever number you get is how many years or the time taken to double your money. So you can decide if you're okay with it, you can leave your money there, or else you can look for another better option if you want to double your money much faster, right? Let's say if you get a different avenue, like let's say mutual fund, or if you're good at stocks or gold or any other investment, let's say it gives you around 12%. Another investment avenue which gives you 12%. All that you have to do is divide 72 by 12. The result is how many years it'll take for you to double your money, right? Brilliant. This is one of my favorite topics. This is what I keep doing it with my investments, right? So brilliant. So let's proceed further and see what's next. Ah, so quick. We've come to today's end of today's session. So friends, I kindly request you to go through this module again if you've not understood something, and if you have any doubts, please type them below in the comment box. I'll try my best to answer them as quickly as possible, right? And not just that, I request you to kindly do me a favor by hitting the subscribe button and the bell icon so that any videos that I post in future will come and reach you. All right. And not just that, also like this video, because this will really help all those people who are looking at the concept, or who want to learn the concept of investing in future. So if let's say a newcomer wants to learn about the concepts of investing on YouTube, based on their search, if this video gets more and more like, this video will be promoted and shown to that person, right? So please hit that like button, subscribe the channel, and hit the bell icon. All right. So that's it for today, guys. Hope you enjoyed watching this module. So please don't forget the ultimate investment mantra, KyebyeWay, which is know your exit before you enter. That's it for today, folks. Thank you. Jai Hind.